Hello everyone, so welcome back. This is Macroeconomics. So in the last videos, we talked about the monetary policy and how the policy tools can be implemented to the economy to affect the aggregate expenditure, and how we can use the monetary policy to resolve the problems of high inflations and recessions. So again, there is a good summary flowchart in the textbooks where you can you can also read it from this PowerPoint slides to actually get an idea about how the monetary policy actually works in our aggregate demand, aggregate supply models. So today we mainly focus on the discussions of the policy limitations and also how the Fed will determine when to use the monetary policy. So traditionally, the monetary policy was set for a target to achieve certain goals that we are trying to target. So for instance, in the very long time ago, the Fed tried to set a target on money supplies. So what it means is the Feds were trying to take controls of the money supplies and trying to set a target for money supply for every years in our economy. So the good thing about setting a predictable money supply targets is that the economy can actually have a good expectations about how much liquid assets will be available in the economy every period. However, if you actually taking a look of the graphs here, which is the money markets that we derived in the last videos, you can actually see how controlling the money supply and interest rates might not necessarily to be done at the same time. So what it means is when we actually taking controls of, let's say, the money supplies in our model, the interest rates might sometimes have to go out of hands. And when our targets is trying to control the interest rates in the economy, however, we might actually lose the control on the money supplies targets. So in this graph, you can actually easily find that the money supply, it's basically taking control by the Fed. And let's suppose if the Fed actually trying to control the money supplies in the economy at the same level every year. What happened is during the expansions of the economy, or maybe during the recession periods in the economy, either the aggregate outputs in the economy or the price level will change, which will alter the change of the money demand. As the money demand curve shifting either to the left or the right, we will actually have a new equilibrium interest rate. So what it means is during the expansions, if the aggregate output increase significantly, and pushing the money demand curve to the right, an increase in money demand will cause a higher equilibrium interest rate in the money markets. So what happened will be these expansions will driving up the interest rates in the economy, and at the end, it might actually have a negative impact to the expenditure in the economy. So that's why if we're trying to target the money supply, it's almost can say for sure we are losing the hands on the interest rates in our money markets. Well, in the later time, the Fed actually came up with a set of policy rules. So this rule is called the Taylor rules. So Taylor rules, it's basically a simple rule that actually developed by John Taylor of Stanford University, which suggesting the Feds should have the monetary policy follow the following rules here, which taking equations where the federal fund rate should be set by using these equations 2.07 plus 1.28 times the inflation rate minus 1.95 times the unemployment gaps. As you can see in these equations, the inflation rates will have a positive impact to the federal fund rates, and the unemployment gaps will have the negative impact to the federal fund rates. So what it suggests is this Taylor rule suggests the way how the Fed use the policy tools to make change of the federal fund interest rates should depend on the current situations in the economy. If we have the inflation rate go up very, very fast, let's say the inflation rate is 10%, well, it should have the equations here suggest to increase the federal fund rates by 1.28 times 10%. So what it means is when the economy actually facing a high inflation, we should increase the interest rates or the federal fund rates in order to cool down or slow down the economy spending. On the other hand, we have the unemployment gaps here, which is multiplied by a negative number, negative 1.95. So what it means is when we actually start seeing unemployment to increase, and the unemployment gap suggests, well, the economy is not producing at the potential outputs and causing unnecessary cynical unemployment. When unemployment increase, this should have a negative impact to the federal fund rate, which will decrease for every one units of unemployment gaps, we should decrease the federal fund rate by 1.95%. And the intuitive reason here is because when the economy jump into a recession, which causing a high unemployment, the Federal Reserve should actually start reducing the interest rates, which is the federal fund rates targets, in order to helps the economy to facilitate the spendings. So this Taylor rule has been very famous and useful to predict the federal fund rates in the United States. Especially this Taylor rules was basically used to make predictions of the future federal fund rates with the given current economic data. However, the Taylor rules, it's a rule that applies what happened to the current state of the economy in order to make a intuitive response to the current state of the economy. But it might not necessarily to be the best target rules to use. The reason is because if we actually depend on the Taylor rules always to make to take actions in the economy by using the monetary policy, the problem is it has to be the case when the economy get into some troubles before we actually taking actions. So it's very proactive. So we don't want this policy to be something that we use when the economy actually have a negative impact to the society. So instead, we want to actually be on the active side and trying to create a rule or maybe a targeting rules that we can be a little bit more aware of how we handle the situations in the economy. So in the year of 2012, the central bank in the United States has publicly setting a explicit targets. And this time, we're not targeting the money supply. We're not targeting the unemployment rates or specifically inflations in the Taylor rule suggests. We're explicitly targeting the inflation rates. And the Fed actually make a public statement saying that, well, they will try whatever they can in order to maintain the inflation rates in the United States about 2% per year. Well, comparing to the Taylor rule, this inflation targeting is basically a very forward-looking policy targets. So if you think about the Taylor rule is a backward-looking policy where we are trying to wait until something happens before we counter it. But the inflation targets, it's basically a set of rules that we are trying to make sure the economy is growing heavily by evaluating the current state of inflations. So that's why we say the inflation targeting is a forward-looking policy rule instead of instead of a backward-looking like the Taylor rule suggests. Well, there's some advantage of this inflation targeting. Number one, it's very transparent. So everyone knows what the Fed is trying to do, and there is no misconceptions about why the Fed is trying to lower the rate or increase the rate. Also, it's very accountable. As we have seen the graph in the previous lecture videos, we know that the target federal fund rates can be immediately, almost immediately met in the economy. Whenever the Federal Reserve is trying to set a target for the federal fund rate or the short-term interest rates, almost the banks and the economy will immediately achieve that goals together. So it's very accountable. So it's very possible for the Feds to actually do a good job to keep track of the inflation rate and trying to maintain within a certain range. However, the inflation targeting is still a very new set of policy targeting tools or targeting rules in the world. It was first brought up in the European central banks and later the United States adopted in 2012. So I would say this set of targeting rules can still be very new to evaluate, and it's good for us to think about the effectiveness of it as we go along the way. Well, remember, we have shown you the graph of this target interest federal fund rates and actual federal fund rates in the previous videos. We would like to take a look at this take a look at this graph again and trying to think about the problems that happened in the year of 2008 and 2009. And as everyone knows, that's basically when the Great Recession starts in the United States. Well, during this 2008 and 2009 periods, as you can see, well, the interest rates or the federal fund rates in this graph has significantly dropped from around 5.5% all the way down to 0%. Well, the question is, it has we understand how the monetary policy tools works in general. The tools are basically used to lower the federal fund rate so that it can attract more investment spending and consumptions and net exports for the country in order to expand the spendings or expenditures in the economy so that we can push the AD curve back to its original positions. However, when we get into the year of 2009, unfortunately, this monetary policy is reaching out to its limits. So it seems like, well, we are reaching to this 0% interest rates that we can no longer push the interest rate further down. And in fact, it's literally, theoretically, not feasible to push the interest rates down below zero. And you can actually observe in this graph, the actual federal fund rates in the United States during the periods of 2009 to 2013 has been very, very close to zero, but never reached to zero, actually. So after the interest rates reaching to the zeros targets, unfortunately, there were almost nothing for the Feds to do in order to actually further push the aggregate demand to the right. So we are reaching to these limitations of the monetary policy at the time of the Great Recessions. Well, when the interest rate cannot go further to zero, so is there anything else the Fed can do? And obviously, we do not have instant solutions in the year of 2008 and 9, but the Federal Reserve actually came up with a new idea so that they can actually extend the use of the monetary policy a little bit further. So in the year of 2009, the Federal Reserve wanted to increase the aggregate demand during the recessions. But the short-term interest rate is already zero. And now they went back to the policy discussions and find out that if the short-term interest rate is reaching to zero, and we know there is a liquidity continuum in our economy, where the short-term interest rate represents the savings and also money demands in the short runs. However, there might be some assets in the long runs that might not have the interest rate reaching to zero yet. So because of that reasons, well, the government is trying to push for another set of policy in order to expand the use of the monetary policy. And in this case, the government is trying to purchase not the short-term government debts to increase the liquidity in the economy, but they begin to purchase the long-term government debts or the long-term assets in the economy so that we can provide even more further liquid assets for people to spend and to purchase the goods and services. And in this case, we actually call this actions a quantitative easing. So the quantitative easing is a very new concept to the world at the time, and we don't even know if that's going to work. But fortunately, the Feds actually were able to push that boundary further in order to create this additional assets or additional quantitative liquid assets in order to push the expenditures in the economy. Well, after the Great Recessions, we start realizing the monetary policy tool can be extended by using the quantitative easings. So that means, well, when the economy is reaching to a low interest rates environment, we might still have some bullets to use. Well, but in general, we actually have to understand the monetary policy. It's not a type of policy similar to the fiscal policy, because the fiscal policy actually has an impact to the economy in the long runs. But the monetary policy is a short-run solutions that actually deal with the business cycles. And sometimes, because the monetary policy will not have an impact to the long runs in the economy, we actually say that, well, the money policy or the monetary policy, it's a neutral one. And sometimes people use the term monetary neutrality to explain this concept. So the money is neutral. What it means is any change in the money supply will not have a real effect on the economy. The only effects of an increase in money supply or decrease in money supply, it's basically changing the aggregate price levels in the economy. So if we think about this example here, let's suppose we are actually at the long-run equilibrium's outputs, where the graph suggests the price level it's 100 and the aggregate output is $12 trillion. If the government actually making a movement in the economy, let's say the federal government, the Federal Reserve actually pushed the economy to the right-hand side by expanding the monetary policy, what happened is the economy will immediately jump to a higher price, but then we can push for greater outputs. Well, in the long runs, remember, whenever the economy has this positive demand shocks in the economy also will adjust by itself. When the overall price level increases so fast, people will start asking for a higher pay for the work in order to gain the values of a dollar to make purchase of the goods and services. And at the end, what happened is, well, the aggregate supplies in the short run will be affected, and slowly it will move back to its original positions, so that the long-run equilibrium will be achieved. And in this case, well, obviously, unemployment will not be changed. After the long-run adjustment, the aggregate outputs will be back to $12 trillion, so it will not be affected. And the only things that will be affected in the economy in this case will be the price levels of the overall goods. So that's why we say in the long runs, wages and prices are not sticky, so it can be adjusted. which nominal wages will rise over time, causing the short-run aggregate supply curve to shift leftwards. And that's why at the end of the day, well, the only thing that is going to change in the long run will be the price level and wages. So you will get paid more, but the overall prices will rise in general so that you won't purchase more. So the end result will be the real GDP equals to potential GDP again, and resulting in a higher price levels. Well, not only the monetary policy will not have impacts to the real variables like GDP, real GDP, unemployment rates, but it also has no effects to other real variables that we have talked about. For instance, we also talk about how the long-run interest rate is being determined by the global fund markets. Well, in this example here, it demonstrates how the change of the monetary policy might not have an impact to the long-run real interest rates in the global fund markets. So let's suppose we begin with the same interest rate for the short-run nominal interest rates in the money markets on the left-hand side, and the long-run real interest rates in the global fund market on the right-hand side. And let's suppose we have the monetary policy that increased the money supply in the economy. Immediately, what happened is we have so much money that coming into the economy, which increase the supply of money and increase the supply of money in the global fund markets, which causing the shift of the supply of global funds. And at the end of the day, what happened is in both markets, we will see the interest rates to go down. And that's the reason why when the short-term interest rate decrease, well, we usually see the long-run interest rate will change at the same time. However, we have to consider what's the consequences afterwards. So when we expanding the monetary supplies in the economy, causing a lower interest rates, the aggregate outputs in the economy will increase because it will shift the aggregate demand curve into the right-hand side. So when the aggregate outputs increase, what happens is, well, the aggregate outputs increase will shift the aggregate demand curve, not the aggregate demand curve, but the money demand to the right-hand side. Remember, one of the main shifter for money demand is aggregate outputs. So as the aggregate demand shift to the right, well, it will shift to a position where it will stop. And this position is not by coincidence, but it should be the same as the original interest rates that we begin with. And the reason is because when people start seeing this money going into the economy and they start spending more money, they will demand more liquid assets in order to complete the purchase. Remember, all the purchase and exchange in the economy can only be done with the liquid assets. So when you have 100 extra additional dollar in your pockets, you will have to determine how to use it. And that will be spent on buying goods and services. And at the end of the day, what happened is, well, people will spend all this money into the economy to make purchase of goods and services, and it will reduce the total savings in the economy, and it will turn things back into the original interest rates that we begin with. And that's why when the expansions of the economy causing a higher level of outputs, it will at the same time increase the money demand, and as a result, the interest rate will be back to its long-run equilibrium wage. And now we are interested in what determines the interest rates in the long run then. So the long-run interest rates will only determine in this global fund markets that we see here on the right-hand side. Again, the money markets that we study, it's only for a short-term movements in the economy. Well, what is the markets that determines how much interest rates people will pay when they're getting a loan, and how much money the lender will get in returns by approving a loan will be mainly depends on the supply and demand for loanable funds. So that's why, well, the interest rates will always go back to the levels of equilibriums where we see the loanable fund markets will determine. So in this lecture, we actually talk about several things about related to the monetary policy. Again, the main takeaway from this chapter is to remember the monetary policy is used to improve the growth of the economy and also to reduce the fluctuations of the business cycle. Well, there is a limitations that we have discussed, and we actually now have a better understanding about how the Fed's actually setting the targets for this policy, so for when to use this policy tools. And also we understand what we mean by monetary neutrality. And hopefully you can actually learn this knowledge of how the Fed's using this monetary policy and get more involved with the discussions in the future. Alright, so this is basically the last lecture for the series. So I will see you in the future videos if we are keeping more topics to discuss in macroeconomics.